Welcome back, guys. We are now in episode 9. Welcome back to the funding table. We're so excited to have you back. Today is going to be me and Sam talking about the 5 things that banks are looking for when you're trying to apply for a home loan.
There's a lot more than 5 things, but today we're just going to talk about 5.
Yeah, so if you just think that applying for a home loan is just about your credit score, you're kind of in the ballpark, but not really. We're going to go and dive deep into the 5 most common things that banks are looking for when you are trying to apply for a home loan. As you guessed it, first things first. It's all about your credit reputation, right? I would say that's the number one thing that banks are looking for is your credit reputation when it comes to qualifying for a home. And why do you think that?
A credit score is basically, it's a quick way for a bank to say this person is trustworthy. They're not going to be able to go through maybe years of your life or things of that nature, but they will be able to take a look at your credit score and your credit history. And so like that score, that credit report, that is a quick way for them to say, this person's trustworthy. This person's going to pay us back. This person knows how to borrow money and pay back. Reputable. You think of that credit score as like a grade in school. You got a good grade, you got a good credit score, your teacher's going to like you, or the bank is going to like you. They're going to be more willing to lend to you, seeing you as trustworthy. So that's probably the main reason why we're looking at a credit score. They'll analyze some things on the report as well too, not just the score, but like, your payment history, what kind of accounts you have on there. Do you only just always have a truck? Do you have, credit cards? Do you have personal loans, student loans? They'll look at the types of accounts, and then they'll look at the payment history.
Okay. So in other words, it basically shows your reliability of paying on time.
That is correct. If they're going to lend you a few $100,000, they're going to want to make sure that you're reliable. And in doing so, they're going to look at that credit report.
And that's so true because like the people that aren't paying their payments on time or having repossessions or having collections, you can definitely tell that their credit score is not obviously in the 800, 700 scores. You're probably like in the 400 to 500 scores. And that just shows that like you're not that reliable when it comes to financing.
As you become good in our industry, I can look at a credit report and, I can kind of tell based off of the credit report and the credit history within like 30 seconds or so if this credit profile is something that the bank is going to want to lend to.
Right. I know when I see the 400 scores, I'm like, girl, you're really good at not paying things on time.
You got to put in work to get that kind of score.
Seriously, like you are just over there nonchalant, not paying things,
And if you're not doing that and it reflects on your credit score, the bank's probably not going to lend you money.
That's right. Like, why would they lend you hundreds of thousands of dollars when you can't pay a $25 credit card bill?
Facts.
Yeah. So the taking points on the credit score when it comes to qualifying for a home loan are your score will show the history of all the payments that you've made. Are you keeping your balances under 30% usage?
And account types. Do you got a bunch of loans, bunch of student loans, or do you have a mix of, credit cards, student loans, personal loans, car loans, things like that?
They will also look at, what are the last 12 months worth of payments being made? Like, have you made any late payments in the past 12 months? That is a big thing that banks are going to look at. So they definitely take a deeper dive than just looking at the credit score. They're going to see if there was any late payments as well. And different loan programs require different types of credit scores to be able to qualify for, first-time homebuyer programs or investor programs. So every program is going to have kind of like a different requirement when it comes to the credit score. But the minimum requirement for FHA would be 580, sometimes even lower, depending on how much assets you have. But 580 is the minimum. It's not something that I would recommend you to have if you're trying to get access to the best interest rates on the market. I would definitely encourage you to at least for the minimum have a 640 credit score so that you can go into a lot of the first-time homebuyer programs that are available for first-time homebuyers. Another thing that banks are looking for, and I would say is the number 2 when it comes to qualifying for a home loan, is your employment history. can you afford the payment of the house?
That's a big one.
Right?
Yeah.
And why is that important, Sam?
Well, not only can you afford the house, but what's your job history like? Are you like jumping from this job every couple of months to this job to this job to this job to having a few months of no employment and then to this job to this job? Like that doesn't show stability. That kind of history shows, you might go without a job for several months, or you might have a lack of income for several months, and that could directly affect your ability to actually make the house payment. So they're looking for the stability of income, like have you been working at the same place for many, many years? That shows
Right.
stability. Or, has there been some jumps in your work history, but always due to some improvement of some sorts? That shows stability. That's awesome. And then, evaluating the income. Are you working, your full 40 hours all the time? Are you on a salary? Are you getting paid by commissions only? And, what's the trend of the commission and what's the trend of your hourly? And
Right.
we're going to evaluate the income wholesale. We're going to take a look at all of it. And, from there, try to determine truly what's your monthly income to be able to make a mortgage payment and look at that stability of income, that stability, that employment history to make sure that chances are you're, a year from now you're going to be employed, whether either at this same job or elevated to another position at another company. And so income, stability, history, all of that is being looked for when we look at employment.
Right. Banks want consistency. They want to make sure that you have the ability to repay back the mortgage that they're going to be lending you. Right?
Spot on. I couldn't have said it better. They want consistency and they want to make sure that you have the ability to repay that loan. That's exactly what they're looking for.
100%.
Spot on, Rosie.
100%. 100%. All right. Number 3. And everybody loves to throw this term around. We are looking for your DTI. What does that mean? Who knows? I'm just kidding. We're talking about your debt to income ratio. What do you owe versus how much do you make?
That's right. Do you make $3,000-4,000 a month, but you got $4,000 of monthly payments on the car, on the credit cards, on the loans? Then you got no disposable income,
Yeah.
We're looking at how much is coming in versus how much is going out. And so that could look like $4,000-5,000 coming in and you only got a car payment of $500. That means you're responsible. You got a lot of disposable income. You don't have a lot of debts that you're paying back. But, if you're making $3,000 a month and the truck payment's $1,000, the other car payment's $500, the loan payment's $500, but you basically, all of your income is already allocated to paying off other debts and you have no leftover disposable income.
AKA you don't make anything.
That's correct.
after everything has been paid off. So yeah, we get clients all the time that say, I make really good money. And I'm like, okay, well, what are your debts? We start looking at the debts and you have a truck payment of $1,500. You have a personal loan of $1,000. So all these payments that you are liable to pay do count against you. So what they're looking for is what's left over, like Sammy said, after making these payments. Do you have anything left over for the mortgage payment, And most people are looking for mortgage payments at like $2,000. That's something that's really comfortable for a lot of people. And so do you have over $2,000 left over of your income to be able to allocate towards the mortgage?
That's right. And if you co-signed on that vehicle for your brother, 3-4 months ago, and you say, don't worry, they're paying for it, that could still count against you. In many situations, those debts will still count against you. So it might not only be the payments that you're making, but it could also be the payments that you've co-signed for a family member or a friend or something like that. So if you do have debts like that, be sure to specify that specific debt because, those can be treated differently, but in many cases, they count against you. So, if you're lending your credit out, that's going to count against you in most cases.
Yes. And I know you're trying to be nice, but if you're looking to buy a house, don't co-sign for anyone at this time. You can maybe do it after you purchase your home, but during the process, before the process, like if you know you're going to look into buying a house, try not to co-sign for anyone and try to keep your debts at the bare minimum.
Buy the house first.
Yes, because nobody wants to sleep in a car.
That's
okay?
Right. That's right.
Lucky number 4.
Number 4, other things that banks are looking for are your assets. How much money do you have? How much money are you putting down? They want to know, do you have skin in the game?
Ballin'.
Why? Why do they want to know? Why do they want to know how much assets you have and if you're putting skin in the game?
Yeah, absolutely. Well, they're basically, joining up with you on this property. You say, I want to buy this property. I want the bank to lend me a certain percentage of the property, and I'm going to put some down payment. They're basically teaming up with you on this property to lend you a large portion of it. So they like to see that you're serious about it as well, too. You got some money in the game. You got a down payment. You have reserves in the bank that show that you're going to be able to be making your payments for a while. Like you're responsible with the money. You have savings. That makes the bank feel more comfortable as well to lend you the money. If the bank is going to lend you 95%, I give you 95% loan on a property, and you're going to be bringing in 5%, they'll say fine, but they may like to see, that you got at least some money in the bank. Mm-hmm. If a bank's going to lend you, 100% of the property, and you're not bringing any down, then they're going to the restrictions start to pile up. So when you are putting skin in the game, it shows the bank that you're serious, that you're ready to have instant equity, that you're willing to put money into the property that's going to be your own. It just shows responsibility. It shows that you can afford purchasing a home. It shows that you're in it to win it. Mm-hmm. You're willing to put some skin in the game.
I love that. Yeah. Savings matter when it comes to buying a house.
That's right.
It really does. They want to see if you have those funds.
If you got that 401k, or you got that annuity, or you got that large savings plan, that is going to beef up your application. Let's say you have a checking account, you got the funds to close, you got your down payment, but, in another savings that you have hidden, you got, 40, 50, 60,000, you have months and months of reserve. Let's document that, because that additional savings and reserves only strengthens your application. Mm-hmm. And makes the bank say, hey, we're willing to lend to this person. They're financially responsible.
1,000%. For sure. And look, when we're talking about assets saved, money that's saved, we're talking about sourceable funds inside of your account.
Not that mattress money.
Not the mattress money. Banks do not want to see cash under your cushion. They don't want to see cash, right? They always want to make sure that everything is sourced inside of your bank account.
Yeah.
The more skin that you have in the game, the less risk that the bank feels that they're making. So think about that, guys. Start saving your coins.
Start saving.
Because it's not just about you, it's about the house. And the last item here.
Number 5.
Numero 5.
Lucky number 5.
Is once you are approved, during the loan process, the bank wants to know if the house that you're buying is going to appraise for the amount that you're buying it for.
Meaning, Rosie explained.
Meaning, they want to make sure that the house that you're buying is worth what you're buying it for.
Because a bank does not want to lend you more than the house is worth. If the house is worth $200,000, they're only going to lend to you based off the house being worth $200,000. If you're buying the house for $210,000 and it's only worth $200,000, the bank's only going to lend you based on that $200,000 value.
Yes.
A bank is never going to want to overlend you what is needed for a property.
Yes.
So.
And why would they? Yeah. Why would they pay for more if the house isn't worth that?
If the house is not worth that, right?
It's all about, is the house worth it? So they're always going to ask for that appraisal, and that appraisal needs to either meet the contract price that you have listed on the contract or higher.
So if it does value higher than the price that you're purchasing it for, that's good news. That's additional instant equity for you. But it at least has to meet the purchase price. Anything under, and you might be responsible for the difference, or you might have to go back to the negotiating table with the seller, and that might not go your way, and you might lose on the house, or you might it might have to be a 50-50 where you're going to come in with half and the seller's going to come in with half. So yeah, that could definitely throw a wrench in the purchase of this property. And if you love it, fingers crossed that it meets value at the purchase price, even higher.
Yeah, and all loans are going to require this. And even in some loans, they're going to want to see the condition of the house You know, they want to make sure that it's going to be safe for you to live in.
That's right.
And if there's wires exposed or certain things that are not safe for you to live in, then they're going to ask for those things to be repaired and ask for another appraiser to go out there to confirm it's sound and livable.
So the two things that the appraisals are looking for, the value, want to make sure that they lend you the proper amount for what the house is worth, and they're looking for the habitability of the home. They want to make sure that if they're lending this money to you, that that house is livable and up to a decent standard of living.
Yes, you might love the home, but the bank also has to love the investment as well.
That's right.
So keep that in mind. So if you're in Texas looking to buy a house, we are licensed in the state of Texas and are more than willing and knowledgeable to help you guys out. Even if you're not ready, we'll help create a game plan to get you ready to purchase your very first home.
Whether your scenario is way over here or over here, whether it's easy, whether it's hard, whether you're self-employed, whether you're W-2, whether you need some help, whether you need some credit advice, whether you're ready to go, whether you're looking for the best deal, whatever it is, contact us.
And remember, approval isn't about luck. It's about your preparation.
That's right. God bless.
See you guys on the next one.
Bye.
Bye.